So hello and welcome to this week's instalment of Nucleus Investment Insights, and we've entitled this one "The Bear Awakes." So we thought we'd cover off on I guess a couple of key themes, global themes, and some of the frustrations that we see that may lie ahead. We'll jump into the content. So we've got we're going to kick off. We've just got a couple of technical difficulties if you heard in the background. The end is nigh. We're going to then look into inflation and how it's not an issue. Chinese growth, however, is an issue. We'll then look at European growth also being an issue. The key one being US growth being the big unknown for today. And then finally looking locally at Australian housing and some of the problems that lie there. So I'm joined today with our resident realist, I guess you could call him, who also speaks fluent Bear, Chief Strategist, David Llewellyn-Smith. Hello, David.
Hi, Tim. Happy New Year, everyone.
And Happy New Year to you, David. And also Head of Investments and another relevant realist, perhaps going to be taking the other side of today. We'll wait and see with Damien Klassen, our Head of Investments. So welcome, Damien.
Thanks, Tim.
Excellent. So let's jump into it, fellas. We'll kick off with inflation.
Okay, so I might... Sorry. Technical difficulties. Let's just jump that chart and go straight.
I think the main thing with inflation, what we're trying to push here is globally for inflation, we don't think it's an issue. We've got a chart up here of Australia, which is showing that Australia's got a 2 to 3% range for inflation, and we've sort of had 18 months below that range. If you go to Europe, you see the same type of chart. Europe's got probably even longer. They're sort of stumbling around about the 1% inflation rate, and they're sort of meant to be up around 2. Australia's meant to be somewhere between 2 and 3. We look through China, inflation is fading away. You look through the US, you can if you're a glass half full person, you could see possible signs of some inflation within the US, but it's very, very nascent, and there's nothing really that would cause you concern, and that's I think that's what markets are looking at in terms of, and what we saw a lot of at the end of last year was that markets are sort of saying, well, the Fed's here just raising rates as fast as it can, or at a relatively fast pace, and there's really no signs that the economy is sort of running away and inflation is any concern.
Okay.
So I think the first step in terms of building the bear case is saying, bear case for stocks and sort of a bullish case for bonds is saying, well, if we were expecting that growth was going to be a positive around the world, then you'd expect to see inflation starting to pick up, or at least being into to more normal ranges. Whereas right around the world we're seeing that inflation well below the targets for most central banks.
Okay. Yeah. Sure. All right.
And just adding to that, there's a very negative oil impulse coming through over the next 9 months that'll make it very difficult for any change in inflation.
Okay. All right. Very good. So we'll jump across into China.
So here we are. If we're kind of stuck in this low-inflation environment, and we also have a number of indicators in all the major economies that are showing slowing growth as well. Now, China, we've been talking about this slowdown now, really for the last 18 months. And this chart that we've got here is the reason why. This is broad credit we've referred to quite often. As you can see, there's been three major growth pulses in China since the GFC, those three little mountains, and those timed with the post-GFC rebound, then a post-Xi Jinping stimulus in 2013, and then another one of those at the end of 2015. That's our little mountain on the right-hand side. As you can see, there's been quite a strong downdraft now for about 2 years in credit growth, and that inevitably starts to drag on Chinese activity, which is what we've started to see, in the last kind of 3 months or so in particular, and exacerbated, first offset by a little bit of pull forward on the resulting from the trade tariffs. But now we're going to the other side of that as well. So we'll also see activity slow as that trade blow adds to the headwinds for China. So there's many different charts we could show you, but the main one that I'm concerned about for China and this credit slowdown is the next one. If you want to bring it up, it's Chinese real estate.
Sure.
I've been anticipating for probably 6 months now a material slowing in Chinese real estate construction. You can see in this chart the blue line is sales, and it's decelerated over the last 6 months, at a decent clip, but then in December it really kind of fell pretty hard. I think to some extent this has obviously been driven by the slowing credit, but then I think there was something of the trade shock that's probably playing out there as well in the latter part of the year. The orange line has diverged from it over the last 6 months, and starts, so it is floor space under construction, has actually continued to grow. But if you look at that chart, they do tend to reconnect over time, and if I was to make that a moving average, you would see that sales typically do lead starts, which obviously is logical. So given the importance of the Chinese real estate sector to its economy as a growth driver, we're basically concerned that excuse me, even though that China has been throwing various forms of stimulus out now for a good 12 months to try and turn this slowdown around, there's still more real economy slowing ahead before they get traction. And that's what you can also see in the previous chart, where we haven't yet seen a turn towards accelerating credit growth either. And typically in China it takes 6 to 9 months before that even impacts activity, as it does elsewhere, but particularly in China. So, why has real estate continued to decelerate? Difficult to know. There's top tier cities, lower tier cities, where the credit gets dispersed, and it's difficult to know what's actually driving this tumble. But it is, it does segue with the slowing credit growth well, and we still think that China will need to do more if it's going to turn this around sustainably, which means, much of 2019 China will actually continue to slow. Even though it's trying to turn it around, we think it might actually be forced to throw the kitchen sink at it before it can get a decent lift.
So when you say that, you're saying central bank easing, essentially?
Basically, yes. I mean, there was good news for China last night with the Fed turning more dovish. It has basically shifted to neutral now, and what has been in China's way to this point has been a tightening Fed and a rising US dollar, which makes the Chinese yuan vulnerable if they were to ease, and then they get spooked by capital outflow, which has various negative impacts, including on real estate, and they don't want to go there. But they might now have the opportunity to begin to ease more aggressively, especially with rate cuts. Plus, no doubt we'll see some more fiscal stimulus, etc. So basically, China to slow further, and they need to throw more at it if they want to turn growth around.
Okay. And at the same time, it's worth noting that, absent the sort of issues we're seeing with Vale in terms of the iron ore, financial markets are largely pricing in, or we think financial markets are pricing in some sort of renewed stimulus in China in terms of the levels of commodity prices and of iron ore stocks, I guess is the other part.
They've run well ahead of the underlying economy, absolutely.
And so that sort of comes to this part about saying, well, if you find an asset where the growth's already been priced in, and that growth hasn't yet been announced, it's all the expectation that this will come, you're saying, well, we think the best case is that the growth does get announced, and that you
it's all priced in and everything's fine.
It's all priced in and everything goes, and you don't make any money on it, and possibly even a little bit buy the rumour, sell the fact. But your downside is that there are other issues, and this growth rate, which David's got some growth rates on these charts, which are interesting, but the other part is that China's been growing so quickly that they're actually at record, or pretty close to record building rates at the moment. And so when you're at record building rates and that's been grown up over a certain period of time, and your number of people moving into cities is actually declining, it's actually very hard to keep that. It's very hard to increase that. You have to actually put a lot of debt into the system just to keep things going. And even that growth rate chart where we looked at the growth rate of debt from year and year, it looks like, you know, while the growth rate's fading away, the actual amount of debt that is needed every year is more and more just to keep you where you are. And that's, China's past the point where, you know, in the early stages of growth, they'd spend $1 on debt and they'd grow an extra $1, or grow an extra $2, and so that was great. And now it's turned into
diminishing returns.
Yeah, now you're spending $2 worth of debt and you're getting an extra $1 worth of growth, and so you're sort of getting half the return. And so there's a limited period of time in which you can do that, and so China's obviously keen not for that to keep going, but every now and again when things slow down, they sort of feel as if they have to just, you know, throw another chunk of debt at it. And I think where we're looking is that things will have to get worse before they get better. So we're going to have to see some more negative growth in terms of China before they get to the stage where they say, well, here's one more big hit of debt to sort of get us over the next hill.
Yeah, which we think they will do, given, you know, that's been their track record.
Yeah, but if that's already priced in, sort of, you want to be saying, well, the risk is actually to the downside here.
Yeah.
Rather than
shock.
To the upside.
Yeah.
We think it's unlikely that there's going to be such a huge stimulus that everyone's going to go, wow, we never expected a stimulus that big. It's more likely to be that it'll either underwhelm or come later than what people are expecting.
Okay. All right. Things to look out for.
Yeah. I mean, there is one more thing to mention on that, and that is, when you rely on investment to drive your growth, it's quite... as Damo says, it's difficult to do it year on year because it's actually only the increase in the amount of investment that adds to growth. It doesn't matter how much you're building. You can be building Europe every year, but if you only build Europe every year, you don't grow. Right? You have to build Europe plus Europe every year to keep growing. That's just the way GDP works. And so with construction so high in China, it's very difficult for them to push even further. Yeah.
And then at the same time, we've obviously got some trade issues going on there, so it's a lot harder for them to push trade. As a, you know, in the past, you could lower your currency a little bit and throw some more money into some of the industrial production and really push that trade angle and effectively use foreigners to buying your goods to help you get past this. Given the trade war and not even just the tariffs that's going on, but the whole perspective in terms of is China moving in the direction that everyone thought that China was moving when they joined the WTO, the World Trade Organization, and certain I guess freedoms that are being lost in China, and certain there's obviously a lot of political tension. Is that in our mind is going to there's no short-term solution to that, and that's only going to increase going forward. And that China managed to get themselves into a sweet spot where people sort of ignored the fact that there were human rights abuses and clamping down on free speech and a number of other things, but it seems as if that period of being able to sit in that spot where they could both sell as much stuff to countries as they could, but also not sort of antagonise the Western sort of liberal democracies. It seems as that period has passed, and so you can't rely on trade, and quite possibly trade is going to be a negative drag on the whole situation.
Yeah, and obviously that inhibits some of your monetary options as well. If you're trying to negotiate a trade deal, you're struggling to cut interest rates.
Yes, and
sink your currency.
And part of that as well, we spoke about inflation not being a big issue, but they're sort of the break glass version of Chinese stimulus is drop your currency and try and export your way back out of this. As you said, there's political issues, but the other issue for the rest of the world is that means there's going to be pumping deflation to the rest of the world, and the rest of the world is already struggling to get inflation going. If then you get extra deflation coming from China as well is just one more sort of nail in the coffin of the growth
paradigm. Okay, all right, fantastic.
Yep.
Well, you mentioned before building a Europe every year, so we'll jump across to Europe now.
Yeah. So basically, China or Europe China is the tail that wags the European dog. Basically, I mean, Europe is a gigantic current account surplus monster that is driven very much by export growth. And this chart shows you that peaked early last year and has been sinking ever since. And as China has hit its growth problems, Europe just tracks it ipso facto. And so, given we see the Chinese real economy continuing to slow, we think Europe's got more problems ahead for it as well. And so you get something of a feedback loop going. Europe's also got some domestic problems, as we know. Although the Italian budget situation got resolved, due to various technical issues, they've got a bit of a credit crunch going in Italy. France, of course, is being rocked by the yellow shirts, sort of mini revolution, which has hit activity there quite hard, and France is more or less in a technical recession as we speak.
Wow. Okay.
And having said that, though, that's quite possibly the way out for Europe is to, if you get a yellow shirt revolution around across Europe, and you get wages at the lower end increasing because and you actually start getting some wage inflation, and you start getting some real push to get, we don't want 20-30% inflation 20-30% unemployment in Spain and Greece, and we actually want people out working and fiscal stimulus
and generating some domestic demand instead of
but that's your best way out, but you're months or years away from that being a reality. And
that's right, and I mean the political problems around that are just immense. You've got the Teutons that run the show, and they're very harsh on the kind of looser fiscal positions and what have you that they would need to take to boost growth and get domestic demand going, etc., etc. So I mean, Euro bonds are still a bit of a dream, etc. So I mean, that's a long way off.
Yes.
And in the meantime, it's just damaging growth. So I mean, Germany as well is obviously the centre of the European export powerhouse, and it's highly integrated with China and emerging markets. And so it is also quite close to recession at this point. It may not be in it, but it's very close, and you can look at any number of different German indicators, and you'll see a very similar structure to that chart. Basically falling all last year and approaching zero now. Last night we had German inflation, which is underwhelming again too. And so what this all amounts to basically is we think the ECB and its planned takeoff for interest rate rises is just going to
fizzle out,
get rubbed out. And then on top of that you've got Brexit. I mean, gauging British politics right now is a bit of a fool's errand, but it's a toss of the coin on whether Europe actually says, okay, we'll extend the deadline for Brexit negotiations or not. It's really just difficult to know at this point, but a hard Brexit is certainly a possibility in the next few months. Then we've got European elections where you're going to see populists taking a lot more market share, as it were. And so the European prospects for this year are again to slow further. I mean, there are some good things. Like one of the reasons they slowed particularly last year was some new vehicle emission restrictions, which hit car manufacturing quite hard, and that will pass. But nonetheless, there's no obvious recovery coming in Europe for the next 6 months at least.
So a lot of the best case is just avoiding all these potholes that there's a whole bunch of things that could blow up, but if you manage to avoid it, that's that's a victory.
Yep.
Just a quick one before we jump into the US. Probably we'll touch on this a little bit more in the investment implications, but obviously a component of what we do is international and in foreign markets, particularly in Europe. So how do things like this play out in your stock selection, Damien?
Yeah, look, European stocks are cheap relative to most of the rest of the world. However, they're not growing as quickly, and so that sort of offsets a lot of that. We've tended to be in sort of exporters and companies within those countries that don't have a lot of exposure. So I guess in Australian parlance, it's the CSLs and the Cochlears of these other countries where we're trying to find sort of the local champions that are quite good, but they're actually world quality
so diversification companies as well outside of their own economy.
Exactly. That have that are cheap because they happen to be listed in some of these European markets that then and so we can buy those companies for cheaper than what we'd see elsewhere in the world, particularly in the US. I think within the we're concerned in terms of Europe. A lot of these Europe certainly looks like one of the more negative markets, and from a currency perspective, they probably need the currency to be a bit lower. And from that perspective, it's a matter of weighing up the risks and returns to say, well, you can buy very cheap some very cheap European companies, but if the currency's falling and they're not getting the growth and all these other potential issues, then and a lot of companies within that area aren't spending a lot on capex because of the whole Brexit issue. And do we need to build our factories in Frankfurt, or do we need to build them in London, or do we build them? There's a lot of uncertainty there. Is that they're finding the companies that will give you some safety in this time is actually relatively difficult in Europe.
Yeah, okay. All right, sure thing. Shall we press on to the US?
Sure.
Okay, so having a quick look here, we've got a quick chart up of the fiscal cliff in 2020, especially if Congress doesn't pass additional spending. So a very big hump in 2018, and then it tails right off.
Yeah, so what we're looking at there is the Trump stimulus, and it begins to peter out from the middle of this year. Obviously, we've had the shutdown as well, which will be a bit of a blow to Q1 growth, but that'll just shift growth forward. So we expect Q2 will rebound. So I actually think the US will be okay for the first half of the year. Then this fiscal cliff headwind starts to kick in for kind of 3 quarters or so, We still think the US will be the growth leader, but it's going to slow right along with China and Europe. So again, you'll get the various feedback loops around that from the various economies via exports.
And part of the benefit for the rest of the world from the Trump stimulus was all this extra demand coming out of the US, and if that extra demand sort of fading away, then
the consumer's still reasonable in the US. The housing market's certainly slowed, but with the long bond being well bid and yields falling away for the last 3 months, that should stabilise housing markets. So we're not predicting an imminent US recession, but its slowdown is simply going to exacerbate the slowdowns elsewhere. Excuse me. And so, I guess if you put those 3 things together, you've got a scenario in which, the Fed has kind of been the first out of the blocks in terms of shifting away from more rate hikes. It's turned a little bit more dovish, neutral, as I mentioned earlier. And so that's weakened the US dollar a little in the short term, but we think both Europe and China are going to be forced to ease a lot more as their growth slows, and so this is going to put sort of more pressure on the US dollar, or at least stop it falling, and that creates a scenario where it's difficult for the world to recover because as long as the US dollar remains high, liquidity into emerging markets and then the flow-on effect to Europe keeps basically monetary conditions quite tight, and so it almost works that you've got to get the US to slow enough for the Fed to roll over completely and smash the US dollar down before you can actually get a decent global recovery. It's basically the Fed is almost like the central bank of the world these days because of those capital flows that come out and flood emerging markets when the US dollar rises and falls.
Okay.
And so the 4x dimensions of these three different economies interacting make recovery difficult as well because US is the growth leader still. So that it sort of adds up to global growth, somewhere below 3%. Anything around 2% is considered a global recession.
Okay.
Typically, how close we get to that is anybody's guess, but it's going to be difficult. Yeah. So if you want to,
the one last thing on the US, there are some potential positives coming out of the US in terms of growth and things like that. If they, you get some more money coming in from tax cuts for individuals over the next few months. And you could see another push for Trump for some sort of stimulus or something that could go on, but at the moment they're the hopeful. They're the ones you might hope for. It's not sort of a base expectation. So the US is sort of probably in our mind has got some upside, but some downside as well. Whereas most of the other ones we've spoken about so far is sort of saying, well, it's pretty hard to see what the upside is, or there's very limited upside, but there is a significant amount of downside. Whereas US is probably a little bit more constrained in terms of not a lot of downside, possibly some upside as well. And on the infrastructure side, we spoke before about the potential for, this is probably early last year, about the potential for some sort of deal between the Democrats and the Republicans to sort of really do an infrastructure push, and that could be the next leg of the Trump boom. That obviously hasn't been a focus, and sort of a little bit of infrastructure on the southern border. So there's we're still expecting they'll get some sort of infrastructure deal, but the clever political thing to do for the Democrats would be to take 6 months worth of negotiations or something like that, and then another year to roll the whole thing out, and by then Trump's actually no longer president, and any stimulus benefits are coming to the
Democrats get the chocolates
to the next the next leader.
Yeah, that's right.
So.
Okay, yeah, fascinating. All right, so that's the US. Let's turn our attention now to local soils. And we won't spend a heap of time on Australia, but
so yeah, I mean that context of slowing global growth should actually be quite difficult for Australia. I mean, commodity prices would normally fall quite heavily in that scenario. However, there's some terrible tragedy in Brazil, which has sort of killed 350 or so people with another dam burst in a Brazilian tailings dam. Has sent the iron ore price through the roof, and is probably going to keep it a little more elevated than it would have otherwise been for the whole year. So Vale is going to lose maybe 15 million tonnes of production. So that's a little bit of an offset to that global context being tough for commodity prices. Coke and coal still quite high. That said, these days the way interests operate in the flows of commodity income in Australia, that money is just not going to reach the real economy. A little bit via the stock market through the big miners, and that's about it. The rest of it, the only other positive outcome that the economy will see from that is budget repair, and it's still in a austere mode, if you like, trying to repair the big stimuluses that have transpired over the last decade. So there's no imminent kind of tax cuts either to help stimulate domestic demand coming from that. So the impacts on domestic demand are going to be very muted. There's going to be a kind of titanic struggle between these technical difficulties in the iron ore market and coke and coal, which is also supply constrained, and what we talked about earlier with Chinese slowing, and whether that real estate slowdown plays out in the first half of the year, which would be a material hit to demand for the bulks. So on balance, things are going to be better than we thought they were, but the prices we're seeing today should definitely come off after Q1, because at the moment there's a big restock that happens every year in Q1. It's seasonal.
Yep. Okay.
So the global context is going to be, not too bad for Australia. But what we're looking at here is the recent NAB survey into business conditions, which has basically tracked an extraordinary boom over the last 3 years, which never really reached households, but and it was very focused in a limited number of sectors, but it did drive what growth we have, especially around urbanisation.
Mm-hmm.
And as you can see in the last, it's obviously been declining now for about 6 months, and in December it absolutely fell off a cliff, December, early January.
Mm-hmm.
And this is being driven basically by a number of different things, but principally the housing bust is probably the key driver. And the housing bust is not getting better. It appears to be getting worse. We could talk about that all day, but...
and we will be next week.
We probably will next week, but on balance, it certainly looks like Melbourne and Sydney have another 10% downside in prices this year before we get any turn. It's the same old story, the credit squeeze out of the Royal Commission, Labor's reforms, etc., like rising bank funding costs, all the usual headwinds. And that has... It appears actually started to force consumers to retrench. Now, this is early days, and we've only got soft data, but it looks like it was a really shitty Christmas for retail. We know car sales are tanking. We had some interesting data from CBA and their spending patterns showing the consumer had fallen off a cliff. And then we've got this new business survey data which is showing that trading profitability have tanked and employment is going to follow in short order. So this is just a nice little kind of representation of where the Australian economy is right now. It is slowing, or where it is right now, it's slowing sharply, and we think it'll keep slowing. Now there's, we sort of started with that inflation chart. Which we had a new inflation print this week, which was relatively soft. Core inflation is still about was 0.4, so it's even easing.
1.8 on an annualised basis.
1.8, and the quarter at 1.4, so it is still slowing. In fact, it was 1.5 annualised over the last 6 months. Right. So it's definitely falling away still, and this chart suggests very strongly that it's going to weaken. We don't have, there's almost no pass-through from the falling Australian dollar and tradable inflation, and housing is a huge driver of domestic inflation. When housing weakens, pretty much all pricing weakens. And so we expect inflation to start falling. Wages, we've seen a little tick up in wages, but that's going to come off because, as you can see, the employment growth is going to slow sharply. We're seeing this corroborated in all the PMIs as well. So, it must be remembered that we have had good employment numbers to now, but it's a lagging indicator, and even on all this data, you wouldn't expect to see employment turn, and maybe not even until the second quarter. Because obviously businesses plan ahead, and so shock takes a while to play out. So what all that amounts to is we think the RBA is going to have to cut. It really doesn't want to. That's very obvious. But with all of these headwinds, and then combine that with the federal election, which itself slows the economy quite significantly. If the RBA doesn't cut, by mid-year Australia is going to be flirting with something quite serious, where you would have rising unemployment feeding into dramatically falling house prices, and a potential bust. So, I could mount various arguments for when the RBA would have to cut, but we think they will definitely have to, and once they cut once, they'll cut twice. And we're not all that confident that rate cuts will turn it around all that much either. A bit of short-term stability perhaps, but unless the Hayne Royal Commission comes in as a real disappointment, that is, it endorses going back to criminal banking, then it will still be very difficult to turn the housing market around. So, it's not implausible that we see the RBA forced to cut 4 times over the next 12 to 18 months.
Wow. Yep.
And the longer they wait, the worse.
The less effect it's going to have.
Well, that's right. The more chance you've got yourself into this negative feedback loop where the rate cuts are really just sort of slowing things down rather than turning it around. So act early. Maybe there's a chance to turn it around. The longer it happens, then the more dire the situation.
Yeah.
Okay.
And that's without any external influences. That's just on our own.
That's just our own.
If we get some negative
shock from something,
shocks externally, then
Yeah, I mean, there's a lot of economists right now looking at commodity prices and arguing that Australia's doing great, but that's yesterday's war. I'm afraid the current slowdown is 100% generated domestically, and those commodity prices simply do not hit the real economy anymore.
Okay, all right, very good. We'll roll into an outlook now. So we've got a couple of cases, a base case, a bull case, and a bear case. So you might just need to run through this colourful chart.
I was more just saying, I think it's probably more, I might talk through the concepts of it, less so than the actual numbers or anything. It's just an illustration. I guess what we're looking at, we've positioned our portfolios now and wound back even further on our equities holdings, sort of using this bounce in stock markets to take some profits. I think if you looked at face value at where our positions are, they're actually extremely bearish if you're sort of saying, well, in terms of the equities are at very low levels relative to where they are from a through the cycle perspective. That's not because we think we're right in the middle of a huge recession and it's all going to finish up, although we do certainly see the risks. It's more of a reflection that we think bonds are mispriced at the moment, so we actually think there's some upside in owning a lot more bonds, because we do think the RBA is going to be forced to cut, and we do think that there's no real concern about an inflation outbreak, and so from that perspective we're quite comfortable owning bonds as to actually make a return from them. So in terms of our base case, we're expecting to actually make some money from our bonds, somewhere 5 to 10%, I guess, in terms of your bonds. We're expecting Aussie equities to be quite negative, to even just coming back to a market multiple, or world market multiple would knock sort of 10% off.
So when you say that the Australian market's trading at
about 10% above the world market.
Okay.
So I guess what we're saying is we think Australia's got one of the worst growth outlooks in the developed world, and in the meantime it's 10% more expensive.
It's been bid up
the rest of the world. So from that perspective, we find it very hard to want to own anything in Australia. So we're at minimum weights pretty much across all our portfolios for Aussie shares,
and also investors can choose to turn off completely Aussie exposure.
Let's say our income fund, which is quite a conservative fund, and that was where we don't own any Australian shares within that portfolio anymore.
Wow.
So we're zero weight Aussie shares in that, and basically with the view that for the very conservative, there's no real reason to be owning those. So we like the sort of the upside. The point then, I guess, comes back to saying if you painted a very bullish case where a whole bunch of things go right, you'll certainly lose out on because Australian shares will go up, but the flip side is we don't think there's much downside in the bonds. We think from the bonds perspective, they're already pricing in a relatively bullish outcome, and so if a whole bunch of these dominoes all fall in the right direction and you get a lot of growth kick on, we're not expecting a huge loss within or very limited. And then the flip side is the bear case, where the downside is quite significant if a number of the dominoes do fall in the wrong direction, and you sort of get those negative cases going. So in terms of weighing up the various outlooks, I guess what we're saying is we think that what's been priced in to markets is wrong, and we think that you've actually got an opportunity to make some money from owning bonds, less as a defensive position.
And more for capital growth.
Although they are a defensive position. Yep. But you've got the capital growth perspective there as well.
Fascinating. Okay. All right. Very good. Anything to add to that one, David?
No, that was the perfect summary.
Yeah. Lovely. Okay. Sure thing. So let's round out now with investment implications. We've touched on a few along the way, but might as well cover off them in fullest.
Yeah,
now.
Sure. So we're not expecting everything to go all in one direction, or positive or negative. So you probably end up somewhere in the middle. If you do end up somewhere in the middle, we think that again that bonds part is the key. Is going to be your key performer. Your biggest negative, so where we could be wrong, is an inflation outbreak. That's probably bad for bonds and for equities. So if you did suddenly see this rush of inflation come through,
and what would be driving a rush of inflation? Though this is the bit
pretty hard to work out what. The biggest thing would be if you got central banks out there pushing very hard again, out printing money. If you got governments out there spending money on fiscal stimulus, and maybe you've got some sort of, you probably need some sort of transfer from central banks to governments, or transfer from central banks to ordinary consumers to help push that whole equation forward. So,
and that sort of inflation, it'd be fairly easy to spot, though, wouldn't it? Or is it sort of something that we're being...
Look, this isn't a turn. This is no. You're not going to wake up one day and suddenly hear that, hey, all the central banks have now decided to open the floodgates and transfer a bunch of money to both consumers and to governments, so that they can get out and spend money without having to worry about debt. That's a long time coming. So we're not. I guess a negative. Where our portfolio would be worse positioned, I guess we're expecting quite a long lead time to be able to see that coming and to be able to start winding back. But some of the parts where you'd actually get quite negative returns on equities, or quite negative returns on risk assets, they can happen pretty quickly, and a sudden rush to a realisation that, hey, central banks have tightened too far, or growth has fallen off a cliff, or the housing markets crash is now out of control and can't be arrested, those types of things.
And so just touching on, so obviously with these series of sort of bear cases, for someone that is going to buy stocks, and this is obviously we rerun an international portfolio that's fully invested all the time. How are these sort of themes interplayed into the stock selection, for example, or sector selection of those portfolios? Yeah,
for us, it's within the international portfolio. It's a matter of trying to walk the path of saying there are certain elements where defensive stocks that you can own that do perform better in markets that are falling
under pressure.
Yep. But at the same time, there's also some growth stocks that get beaten down from time to time, and you want to take the opportunity to buy them when they're cheap. And so it's a mixture of trying to look through the portfolio and say, look, here are elements of the portfolio and we do think will be defensive throughout it, and then here are elements of the portfolio where we might even go backwards on those earnings over the next on the sort of share prices over the next year or two. But we're actually really happy to own these stocks at these prices, because we think at some stage we're going to make a lot of money from those positions. And so part of investment is sort of acknowledging that you will get your better returns from your equities over the longer term, and using your other assets to sort of tip in and tip out and find these assets and buy them. So I guess what I'd be saying to people, and that's why we don't have zero weight equities. We do think there still are positive scenarios where you'll make there might just be flat earnings over the time. You might not. I think in our base case, international equities were sort of offset any falls in price, and are sort of offset by either your dividends or your falls in Aussie dollar. So there's certainly benefits in still not being zero weight in some of the more aggressive portfolios. And there is the opportunity to certainly pick up some great quality stocks at quite cheap prices, and with a sort of a through the cycle view.
So the classic example might be consumer discretionary over staples, where you might not buy a new car, but you still need to clean your teeth at night, sort of thing.
Yeah, so that's the one side where you'll go, okay, well, you've got your consumer staples with a view that yes, I'll be holding those, and they'll give me some defensive protection as things fall.
Yep.
And then you'll go, well, here's a consumer discretionary stock that I actually really like that stock, and it's always been really, really expensive, but now might actually be the chance to, or at a certain time over the next 6 to 12 months, there'll be chances to pick these things up at prices you'll probably never see again.
Yep.
And so
take the long-term view.
Yeah, avoid the lower quality ones of those, but there'll be a few of the higher quality ones you can pick up. And
okay, fantastic, great example. So outside of that, though, Australian stocks underweight to zero weight, as you've mentioned, which is remarkable. Okay.
Yep.
And everyone's we all get on the bonds. So, but bonds tipped to be a strong performer. Okay, very good. All right, well, thanks very much, gentlemen, for that terrific run through of the bear case. And we'll finish up there for now. We'll just roll into, of course, what's coming up. So next week we're going to be looking at the Hain Pain for Aussie Housing, working title. As you may or may not be aware, the Hain report for the Royal Commission into Banking is released hopefully Monday night, and so we'll have a little bit of a run through, and hopefully our Chief Economist Leith might pop along as well to discuss implications for the Aussie housing market. So same bat time, same bat channel, 12:30 p.m. Eastern Standard Time. I promise we'll start at 12:30 next week on the 7th of February. And of course you can head over to the Nucleus Wealth Live webinar page to check that one out and comment and get your questions answered live. So if you liked what you've heard today, you can, of course, head over to nucleuswealth.com/subscribe and provide us with your email, and in return we'll send you weekly emails with the webinar topics, links for our podcasts. Of course, we're up on Spotify, iTunes, and wherever you get your quality finance podcast from on your Android system, and of course any other news from Nucleus Wealth. So on that note, I hope you've enjoyed today, and we look forward to catching you at the next one. Cheers.